As interest rates rise, could you be falling into a mortgage trap? Today, we're going to look at Madeline and Jacqueline's story. They've recently been hit by some mortgage pain, and we're going to talk about their situation and what you can do if you're experiencing similar things, especially given that we've seen 5 rate rises in as many months. So let's dive in and have a look at their story and get a bit of a better understanding.
Madeline and Jacqueline Darkovska are fighting to hold on to their home.
It's been really hard. Haven't been able to afford a lot of things, like a basic living.
The twin sisters are among a growing number of Australians who can't refinance their home loan.
We've been struggling a lot. I've recently just lost my job, or my hours have actually been cut.
So let's look at the first one. Is if your hours are cut back, what can you do if you've got a mortgage and you're struggling to meet your commitments? Now, the first thing is, one, have a chat with your lender. You can arrange to rechange your repayments to maybe interest only, or even do a repayment freeze. Also, understanding where the market's at. We can see there's Dan Murphy's promising 10-minute job interviews because they need to fill 280 casual positions in WA and across Australia. We can see Nando's has the same thing, 10-minute interviews where people that walk in for an interview will get free food. So understanding the market, we know unemployment is at a record level of low, and there's a large number of corporations that are seeking employment, especially skilled labor or even unskilled labor, where you might be able to get some work if your hours have been cut back. Now, obviously, it's not ideal, and if you're working in a professional job, working at Dan Murphy's or Nando's might not seem appealing, but it will get you through those tough periods of time, particularly in this situation where hours have been cut back.
At the end of 2020, they took on a loan with a smaller lender because they didn't have a 10% deposit. That came with a higher variable rate. Their repayments have risen $300 a month since May, when the RBA began hiking rates.
So there are a few key takeaways here. One is, yes, if you do have less than a 20% deposit, sometimes the lenders do charge higher interest rates. As a first homeowner today, there's a bunch of schemes available that will get you through and into your first home with minimal deposit, plus not paying a higher rate. There's a first home guarantee scheme, which effectively lets you in with as little as a 5% deposit, whereby you can get in the market, plus the banks give you a rate as if you've got a 20% deposit. Unfortunately, with Madeline and Jackie, in their case, they'd initially gone with a lender because they could work with a minimal deposit, but ended up paying a higher variable rate. Back then, they might have considered fixing in the rate. Now, in their defense, in 2020, the Reserve Bank was confirming again and again and again that the cash rate wasn't going to move until 2024. And we've seen the exact opposite happen in the last 5 months. Now, with rates going up, Maddie and Jacqueline could have a chat with their lender and see if they could renegotiate and get their rate down. Or, as we can see in that picture there, their variable rate is in the 6s. There are fixed rates at the moment where you can get in the 4.9s, 4.6s. So it might even be worthwhile having a chat to your lender and seeing if you can fix in the rate and getting a bit of stability. Now, for those out there that have had similar things happen to their mortgage in recent times with the variable rate going up, it pays to talk with a mortgage broker like ourselves, where we can review your loan, see if we can renegotiate, get the rate down, or even refinance. There's a bunch of lenders that give refinance rebates at the minute where you can easily get the rate down from 6 to in the high 3s right now. So definitely worthwhile checking out.
Well, mortgage prison is where you can't refinance, and the main reason that would be is if the equity in your property falls below 20%. Why? Because banks typically will charge refinances, lenders, mortgage insurance, which can run into the tens of thousands of dollars.
From October to March, it's estimated more than 176,000 mortgages were taken out with a deposit of 20% or less.
So how can you work out if your mortgage is trapped and you can't refinance it without having to pay that mortgage insurance? Well, the first thing you want to do is get an understanding of what the property's worth. Remembering, you don't want to be refinancing if you're lending over 80% of the property value. So how do you find out the value of the property? Well, one, you can talk to a real estate agent. Two, you can talk to your bank or broker who can do an assessment or valuation. But the quickest way and easiest way to find out is jump on realestate.com and fill in some basic parameters. Update the filters with your suburb. Also put in the type of property, house, unit, townhouse, and number of bedrooms, as well as the land size. So for example, here we've got a suburb in Queensland of Bald Hills. I've put in a house with a max 2 bedrooms, over 300 square meters, and we can see here properties that have recently sold. Now the properties that have sold closer to today's date is always better, but it'll help you understand and calculate the mortgage insurance. We've got a lender's mortgage insurance calculator on our website. You can search it on Google and find it, and you can see straight away if your loan is $450,000 and your property is worth $500,000, well, it's absolutely not paying $9,500 in mortgage insurance to refinance, and technically then you're trapped with your lender. So you always want to be making sure you're not lending more than 80% of the property value when refinancing, because that lender's mortgage insurance makes it not worth your while.
Falling house prices aren't the only reason Australians are trapped in a mortgage prison. They now face tougher lending tests imposed by the financial regulator. That means that banks are now assessing their ability to repay the loan at 3% above the rate they locked in, instead of 2.5%.
So as we can see here, you might not be trapped in a mortgage based on your equity position, but you might not pass the bank's updated borrowing assessment. So let's take a look at your borrowing power in a hypothetical scenario, what it looked like before the rate rises happened and what it looks like after, and how much more income you need to get the same loan amount. So let's say you're a single person earning $100,000 a year. Before all the rate rises happened, your maximum borrowing ability was $761,000. Now, fast forward to today, we've seen 5 rate hikes. We can see the cash rates in the 2% mark. You're earning the same income, but your borrowing power is actually reduced down to $663,000. That's a huge drop, nearly $100,000. So if you've previously lent and you borrowed to your upper limit, you're also going to be mortgage trapped from refinancing, even if there's equity in the property, because the banks want to do a new assessment based on the updated criteria that the regulator has. What do you need to do to qualify for that same loan again? Well, your income actually needs to increase from $100,000 to $112,000 to be able to borrow the same amount of lending. And we can see here, this is another reason why you might not be able to move your mortgage and could potentially be trapped in the mortgage itself. And that's why it pays to review your mortgage, especially as we see rates going up. It might be that you're currently in a position where you can do something, but as rates continue to increase, as equity goes down, as your borrowing power goes down, you might actually find yourself in a predicament where you can't move. Now, keeping in mind, for every 0.5% increase in the cash rate that the Reserve Bank does, your borrowing power actually reduces by about 5%. So we've seen 2.25% increases in rates in the last 5 months. That's actually reduced your borrowing power by over 20%, which really puts it into perspective, and we can see how much of a difference these rate rises have on your ability to borrow.
Urges borrowers who are not yet in a mortgage trap to consider refinancing and ask lenders to waive upfront fees.
If you think that the proportion that you own of your home could slide below that magic 20% mark, think about taking action now.
And her advice for those who are trapped is,
The key is not to panic.
As property prices have declined in recent times and you're thinking of reviewing your mortgage or releasing some equity, feel free to hit us up here at Hunter Galloway. We'd love to have a chat and see what we can do. There's no cost for our service and we can certainly assist. And remember, if you are facing mortgage stress or you are trapped into your mortgage, there's always things you can do. So it's important not to bury your head in the sand. Reach out with experts like ourselves and we're happy to have a chat and see what we can do. And as always, guys, thanks for watching. We'll see you next time.